Hey everybody, Dr. Richard Smith here with the Foundation for the Study of Cycles and Cycles TV. And this week, we are going to be doing a deep dive on the US dollar, too big to fail. We're going to be covering the dollar, stocks, gold, Bitcoin, what's going on with the Fed, treasuries, yield curve. I got to pack in enough for 2 weeks because next week I'm not going to be able to do it again. So here we go, folks. This is Trading Market Cycles. All right, so welcome and thanks again for joining us. Thanks again for supporting Cycles TV. All the great work we do here, we really appreciate it. But we got a lot to cover today, so we're just going to get going. Get busy and get going. Let me make some adjustments here. All right. So I wanted to just start out briefly with a little bragging from our analysis of Nvidia last week. So here we have the 1 hour data on Nvidia. And remember, we said, if you were watching last week, that it looks like there's a little support on the hourly cycle chart for Nvidia. And indeed, this blue, light blue data here is what happened after the fact. Here was the forecast right here, November 17th. And Nvidia reported on Wednesday. We got that huge spike up, right? And then an absolute bloodbath selling off. And this morning, it's not on this chart because this is yesterday's data. But last I looked, Nvidia was down at about 170. So the daily cycles in Nvidia, this is what we looked at again last week, where we said, looked unattractive, serious headwinds. And indeed, so far, the daily cycles on Nvidia seem to be having their way. And momentum still down, cycle swing momentum still down, daily cycles still down. Serious headwinds for Nvidia. Meanwhile, our bigger thesis that we've been working on, okay, is that essentially the US dollar is the oil of the global financial system, and it is, by all accounts, too big to fail. So I know many of my friends out there are anxious to see a collapse that the cycles might be predicting. It's logical to think there's going to be a collapse because when you do apply reason to the current situation, it doesn't make a lot of sense. What I'm tracking, though, my core thesis is that, oh man, if it does crack, if the global financial system cracks, we have no idea what's coming. Nobody has any idea what's coming. I don't want to live through 1929 again. I don't know about you. I really don't. And I don't want the rest of our brothers and sisters on this planet to have to live through 1929 again. So I am not anxious for a crash. And meanwhile, I recognize that a crash may happen. We've got to have our worst case scenarios covered. But my ongoing thesis is that we're going to do everything in our power to stop a crash from happening. And the key to that is the US dollar. And probably rather than a crash, we're going to have a slow slog over the next 5-10 years. Until things start to pick up. So this is the basic thesis that we've been following, and then we've been looking at how, given that the Federal Reserve has stepped back a bit from providing liquidity, Now we see that liquidity coming from money markets, stable coins, AI, CapEx, all continuing to drive Treasury issuance, private credit, right? All driving Treasury issuance because US Treasuries and the US dollar are practically the same thing. Okay, people have dollars, they can they can borrow those dollars by collateralizing Treasury, right? So if you have Treasuries, T-bills, you can go borrow dollars with those T-bills in the standard overnight financing rate market, the SOFR. And if you have dollars, you can go give them to the Fed if you're one of their member banks and get some T-bills back. So T-bills and dollars are highly, they're not exactly fungible, but they're close to fungible. Okay, so that is the system that we're living in right now. And just to follow up a little bit on this, then we'll get to the charts, the cycle analysis. Here is a chart from the Federal Reserve showing money market funds, total financial assets in the United States, okay, from 2022 up until Q2 2025. That has gone up by $2 trillion, $2.5 trillion. And what do money market funds do with their money? Well, for a while, they were putting them at the Fed and earning a little interest, but that's not happening anymore. And they are buying T-bills. Money market funds are buying T-bills. So that's one source of more liquidity for the Treasury market because the US government has to continuously refinance its debt, right? This is the fiscal dominance that we're living under right now. Here is a similar chart showing the growth in stable coins. So from $123 billion in January of 2024, all the way up to $300 billion in October of 2025. So more capital going into stable coins and like Tether and Circle. And guess what? They have to buy treasuries. So more liquidity for the T-bills market through money market funds, stable coins, and then what we've been talking about, the AI CapEx loop to ultimately support the long end of the Treasury curve. Okay, so these data center spending, I have OpenAI data centers here, but it's not just OpenAI, right? The mega tech lords are talking about spending $5 trillion. $5 trillion. It's an unfathomable amount of money using unfathomable amounts of electricity that don't exist yet. But all very long-term debt, 7, 10, 20-year long debt. And guess what that does? As that debt gets cycled by investment funds, it goes back into treasuries and supports the long end of the treasury issuance regime. So meanwhile, we've seen Nvidia taking a hit, right? That is a concern, but guess what? Google to the rescue. Google's soaring stock, defying fears of an AI bubble because Google's got some new chips that it's using to power its Gemini services. Maybe Google will become a competitor to Nvidia because they're in-house chips. So, if ever there was a false choice, it's the choice between Nvidia and Google. But look, the show's got to go on. The debt market has to stay open and manageable. And really, none of us know what the world looks like if this regime collapses. So it's not going to be a collapse, more than likely. It's going to be just slower growth, sticky inflation, and a slog while we figure out what's next. This is the, which one is this? This is the Treasury general account, right? So this is the, how much money the Treasury, the debt, essentially, almost, it's a lot. Let me just go back to 5 years here. These are in millions of dollars. So if we think this is like 100 trillion. No, could it be 100 trillion? Anyway, it's going up. Treasury's still borrowing more money. We're going into more debt. This is the Fed balance sheet, the total assets, right? So they told us they're going to be ending QT. So that's going to be tailing off. And this is the reserve balances. So we're expecting this to stop declining. So the Fed has said that they're going to start buying treasuries again, especially shorter term treasuries, to get their balance sheet more in line with the issuance regime of Treasury, who's issuing a lot more T-bills than they are 10-year notes. But so far, I would say it's stabilizing, but not rising. So, this is part of liquidity not really being there in the same way that it was there, say, back in 2022, 2024, etc. Okay. Here we're looking at the yield curves in treasuries, starting from the R reverse repo here, 1 month, 2 month, right? Here's 2 year. And the blue is the current treasury yield curve, right? So 2 years have come down quite a bit. If we look back to 1 year ago, they were at 4.2. This is from November 25th, 2024. And today, November 24th, 2025, they're at 3.46. So we've absolutely seen the yield curve go down, right? All across the whole spectrum. Certainly out to the 10-year, a little more questionable out of the 20-year and the 30-year, but yield curves have been down, or yields have gone down across the board for the past year, particularly in the past 6 months, which is what this gold curve is here. All the yields have come down significantly from there. So we still have a, it's not inverted, right? So that's good. But the short end's going down more than the long end. So the long end is staying sticky out here, staying higher, while the short end, like the 2 years, the 1 years, have come down. So the belly of the curve, so-called, is here around the 2 year right now. That's where the lowest interest rates are. And we'd like to see this continue to come down in the shorter end, but it's not actually happening yet. So when we start to see, 1 month, 2 month, 3 month yields coming down, that's when we'll see more liquidity coming into the system. And that's probably when we'll see Bitcoin and other risk assets rally more. But so far, not yet. All right, so that's the big picture in terms of what's going on in our fiscal dominance, treasury refinancing reality that we're in right now. So now let's take a look at the cycles. We're going to start out here looking at the dollar itself, okay? And this is weekly data on the dollar. And we see that the most stable cycle here is this 180 week cycle. It's the only cycle with stability score above 50. Okay. The 180 week cycle should be familiar to us all here. It's roughly the 41 month cycle that's also present in the stock market. And the dollar, this cycle has been pointing up, but we haven't really gotten a big rally in the dollar. In fact, it's lower than it was at the cycle bottom. We had a rally here, but it's come back down. So on the weekly data, I'd say we have some positive momentum. You know, we have a CRSI buy signal here. It's not in conjunction with the cycle bottom, but still the momentum looks constructive from the levels that we're at right now. That's where we're at on the weekly data. On the daily data, this is using 850 bars. Let's go add a few more bars here and got this pretty nice 300-day cycle, but we only have a few iterations of it here, but that is very strong cycle with stability of 80, right? Let's go add a couple hundred more bars and maybe even 500 more bars, see if we can get a little more granularity on this cycle. So this 319 and 208, but even more importantly, let's turn on our indicators. And we can see on the daily data, right, we've had a pretty good rally here. Looks like it might continue a bit. So I'd say we have some constructive developments in a possible dollar bottom, but we'll see. We'll see. The dollar's obviously down a lot from its highs back around 125 in the not too distant past. When was that? Yeah, way back here. And well, that's way back. So we were as high as 112 and then 109. So overall, I'd say the dollar looks to be bottoming. But this is a very important asset to keep our eyes on, to be paying attention to, because the dollar really is the key to the global financial system that we're living in right now, along with, of course, its sibling, which are the treasuries. So we've also been following the volatility in the treasuries, right? The move index. And we can see here that the move bottomed back here and it had been rising, but it's falling again. And the cycle supports more declines. And we've seen the momentum shifting. So wouldn't be surprised to see volatility further receding. Certainly it doesn't look like volatility in the treasuries are likely to be soaring from here. I think that's supportive overall of there not being an imminent collapse. This is another volatility indicator, not quite as sanguine as the move index, but this is the high yield spreads. But historically, we can see the spreads are still very low, right, relative to where they have been. So they've come down from being quite high up here. Let's see. Right, those are on. Okay. So they were like over 5 up here. And they've been trending down for the past couple of years, spiking once in a while. And we may see a little more rise here, but I'd say historically these are low and they're not signaling a big crisis in the markets yet. Okay. I know what's happening with, say, the Oracle CDSs that everybody's talking about now, where, you know, the debt in Oracle is getting expensive to hedge. But Oracle is kind of a unique situation. And yeah, look, I think that there are problems with the AI CapEx story for sure, but the show must go on, and we don't see any real crisis indications yet in any of the assets we've reviewed so far, which is basically what I've been saying for the past couple of months. This is the very short-term SOFR minus IORB, the interest rate on banks. Again, not in crisis mode here. This is the latest data as of November 24th. We still see that SOFR is above IORB, which means, you know, treasuries as collateral are doing just fine. Thank you very much. Now let's look at stocks. Okay, this is the S&P 500, and this is a beautiful cycle here, this 194-day cycle. It's the #1 stable cycle at 74, and it's the #1 ranked cycle. Okay, so when you get a cycle that's the #1 stability cycle and the #1 ranked cycle, that is about as good as it gets for cycles. So, and momentum is down, and the cycle swing momentum is down. So headwinds for equities, no doubt about it. And last week I talked about, you know, essentially there is a Fed, Trump, BlackRock, Blue Owl, Blackstone put. And lo and behold, this week we started hearing from Fed officials that, well, a December rate cut actually probably isn't as unlikely as we suggested it might be. So markets start to get a little shaky, and the crisis prevention team steps in to make sure that the show must go on. That's the pattern that we've been seeing, that we've been living through at least since 2008, probably even earlier than that. Does it get more absurd and more absurd? Yes. Is there an alternative? There is no alternative. Okay. Does it mean that we should back up the truck and be invested in this regime? I don't think so. I think we have to protect our worst case scenario and diversify. But this is how it looks to me so far. All right, here's the Nasdaq. Obviously, quite similar to the S&P 500, getting a nice bounce over the past few days, getting a lift from all the talk about all of a sudden about there being a December rate cut seeming more likely. Got a similar cycle, 195 days here in the Nasdaq with stability of 79 and rank 1. And this is over, you know, how many iterations of this cycle? If we go from 1, 2, 3, 4, almost 5 iterations of this 195-day cycle. That's a substantial number of iterations, and it's got very high stability and #1 rank. So don't have to look much further than that to see that it's going to take some intervention to stop this cycle from having more impact than it otherwise would have. And I think we've started to see that this week. Bitcoin is our canary in the coal mine as far as liquidity is concerned, and Bitcoin has been, you know, giving us warning signs here for at least since early October. Lars did a beautiful analysis on Bitcoin right about back here, showing the issues, the concerns. We've got 850 bars here. You know, this #1 stability cycle here of 241, that's only 1, 2, 3 full instances of that cycle. So I'd want to see a little more history on that to get more confidence. You can see it on the chart here quite clearly. Yeah. All right, let's go back to this bottom in Bitcoin at 20,000 back in 2022. Remember that? And so when we add a little more data, right, we see this 82-day cycle. Now that's very strong. Number one, in stability and rank over what, like 20 iterations of this cycle or 15 iterations of this cycle. This 256-day cycle is also strong, but it's not as clear in the spectrum. That's why its rank isn't as high, but there's clearly something going on up here in this kind of 200 to 250-day range. And when we look at those together, you know, we see signs of life here from the cycles in Bitcoin. If we can get some more liquidity in the system through a December rate cut and the other mechanisms of fiscal dominance, then there may be some hope. But the momentum certainly is down, bottoming a little bit, turning up here in the cycle swing momentum. But this is the proverbial falling knife. So definitely something to be cautious with. Ethereum, not surprisingly, looks similar to Bitcoin. Let's go back a little bit further here. You can anchor off this bottom when Ethereum was at $1,000 back in June of 2022. That gives us 1,222 bars. That's a good sample. And look at this 270-day cycle with a stability of almost 80 and rank number one. So that's very nice. We see momentum possibly bottoming, right? The cycle swing momentum turning up. So this looks mildly constructive in Ethereum, even though this cycle hasn't quite run its full course, but there are cycles and cycles within cycles, right? And if we look at some of these other cycles on the chart, that can move the potential bottom a little bit closer. So I'd say Bitcoin and Ethereum aren't out of the woods yet, but I do see some constructive developments in terms of the momentum indicators and the stable cycles potentially bottoming. Gold, also part of the dollar story, right? Bitcoin, Ethereum are kind of the canaries in the coal mine for the liquidity coming back into the system. And gold is the primarily kind of the dollar debasement trade, which has been doing very well as people think logically that, boy, I don't know how this dollar keeps keeping its head above water. But let's have a look here. We know that the cycles in gold, I mean, all of them here are red or turning red, right? All the top cycles by stability, because gold's been on a monster rally. And we've had a big drop in momentum without a huge drop in price. Okay, and gold now rallying a bit on the daily data is pretty interesting that we haven't had a bigger correction in gold given all of these cycles topping and momentum coming down as much as it has. So definitely the headwind's still there for gold, but on the whole, you have to be impressed by the strength that we've seen from gold, certainly back to, for the past couple of years, into this peak at 4,400. Yes, a drop, but now moving higher again. Going to have to keep an eye on it. And similarly, silver, very similar to gold. Let's add a few more, a little more history. And go back. But again, all of these cycles. Whoa. I'm not sure I've seen that before, where every single cycle is red. There are a couple short-term cycles bottoming. You can tell those by the green dot, the orange with the green dot telling you that that cycle is bottoming, but this is a 23-day cycle. That's very short term. So again, silver, if we just take all the stable cycles above 50, rank 1, rank 2, rank 3, right? Even if we just look at this top rank cycle here, the 330, stability of 90, okay, over 1, 2, not quite 3 cycles. So you'd want to see more history to really take that one seriously. But if we look at the shorter ones, right, they're all pointing down and momentum is deteriorating, right? So that looks like a tempting short, but again, you have to respect the strength with silver, moving from over the past 2 years from $21 to over 50, and price not coming down a whole lot in spite of this major cycle tops and working off a lot of excess momentum, and even making a new high in momentum here in the swing momentum, not in the CRSI, right? But that's pretty good. So let me stop here now and come back and see. Go to comments here. All right. So again, we know where the cycles are, right? Headwinds for equities, crypto, although those headwinds in crypto started a month ago and maybe working themselves to bottoms. Gold and silver certainly have been topping from the cycle's perspective, but haven't had major corrections given their gains. Looks more like consolidating gains right here. The US dollar looking mildly constructive for a bottom too. But all of this, of course, in the bigger context that we have to acknowledge because it's part of the bigger cycle, right? This is the 80-year great cycle of that Ray Dalio talks about. By the way, there was a great interview of Dalio on the Odd Lots podcast that I highly recommend. And just him reflecting on his 50 years and talking about cycles and the pickle that we're in terms of the federal government and the Federal Reserve right now. He's pretty clear-eyed about it, and I think his perspective is one that I share. So we have to understand what the big picture is, what the context is that these shorter term cycles are occurring in, okay? So basically what I see is that I'm looking for cracks in the system. I don't really see them yet. And I know that there really is no alternative to the US dollar that doesn't involve a major shakeup of pretty much our entire way of life right now. So that's just not something that the powers that be or really anyone wants to see. So I think that's what we have to keep in mind and what we're living through. and what we have to understand as the context for the cycles that we're looking at today. So let's see if anybody's got any burning questions. Again, I'm not going to be here next week, so please do let me know if you have any questions. Google's new chips are expensive because they are not Fritos chips. Okay, got it. They're not Fritos. They're not free. As we are heading towards presidential elections in Brazil, is it possible to review the EWZ? Sure, we can take a look at that. Good, I like it. Infinite debt creation can only lead to an intrinsic value of 0. It's just a question of time. I don't disagree, Dancing Shiva, but that can be a long wait. And yeah, I don't have all the answers, but that is the logical assessment. Meanwhile, it's been the logical assessment for almost my entire career in markets of 25 years, and it's only gotten worse. As an investor in Europe, I sold the remainder of my T-bills ETF yesterday at a small profit. I have little confidence left in the dollar and T-bills and no confidence in Donald Trump. I hear ya. I hear ya. It's hard to have confidence. I just call this the Tina trade. There is no alternative. And yes, it's, some kind of extrinsic event could trigger a major catastrophe, but in lieu of that, I think it's going to be a slow slog as we figure out a new world order, but we're not there yet. Oops, backtracking here. In January, the 2 daily cycles are joining the weekly cycle. How, speaking about a bottom of the USD. Not sure, Bruno, exactly what you're getting at there. 2 daily cycles are joining the weekly cycle in terms of maybe all pointing down. I think that's certainly possible. Excuse me just a moment here. All right. And right, I mean joining weekly cycle down. Yeah, so a strong bottom in the dollar and rally in the dollar would certainly undermine the Trump ideal of reshoring manufacturing and making American exports less expensive. So I think that's a plausible scenario, Bruno. Thanks for bringing it up. All right, Mark, the dollar gold spread is one to keep on the radar, ETFs or futures. Yeah, absolutely. US dollar priced in terms of gold or gold is a good one to keep an eye on. All right, well, let's wrap things up here. We'll take a look at EWZ weekly and daily. See if I missed anything. The DAX, okay. And 2.18 trillion added to U.S. national debt thus far in 2025. I know, it's utterly incomprehensible. All right, EWZ. Start out with the weeklies. When you see a huge, wow, what was this? This was the great financial crisis, I guess, from 53 down to 16. Yikes. And crazy. So we have here a very clear cycle. Number one cycle, number one stability. You can look at our indicators. And I'd say things look pretty good on the weekly data for Brazil. You got a breakout above the top of the cycle RSI here. A little more life left in this cycle, right? Could even see some right translation. We'll see. But that chart looks pretty good to me. And if we drill down to the dailies, daily looks a little shakier, but also very strong cycle here at 74 with a rank of 1. Number 1 stability, number 1 rank, and more than 4 iterations of that cycle. So that's a good setup, and definitely looks toppy on the daily. Maybe a little sell-off after the election, but looking at the longer term cycles, the weeklies, it doesn't look like the end of Brazil. So we also had a request for DAX. Let me see if that is in. I might have to look up the DAX. Okay, just DAX. Hopefully we're looking at the right thing here. We've got 850 bars, some very clear cycles, 101 weeks with daily, weeks here. Oh, this is only 496 bars. Okay, so, but that's enough for 101 week cycle, right? And it's been a good cycle, right? Bottom, top, bottom, top, early bottom, nice bottom there. Blew through the down cycle there, but momentum definitely waning. CRSI sell on a number 1 rank, number 1 stable cycle. So that looks like cause for concern, similar to what we're seeing in the US stock market on the longer term cycles. And if we go to the daily data on this one, one cycle rules them all on the daily data, but we'd want to see, this is 1, 2, 3 iterations of this cycle. I'd want to see a little bit more than that for such a long-term cycle. So let's add some more there, but it still holds up pretty good. So that's a strong cycle there. You can bring in some of these shorter term cycles as well. This one's got stability above 50 and rank number 2. So those two together are pretty interesting, and I'd say shows a possible bottom forming, but not out of the woods yet. Probably until early 2026. All right. Well, for those of you that are in the United States and are celebrating with family this week, getting together with family, I hope everything goes well and smooth. And I'm going to be on the road taking kids back to school next week, so I won't be able to do TMC, but I'll be back in a couple of weeks. And I thank you for all your support. Just a reminder, we do have a couple of slots open for Masters Working Group memberships. Please contact Dr. Barton, dr.barton@cycles.org if you're interested in putting your wits together with 49, 50 other great cycles students and practitioners and leading lights, including Larry Williams, Jake Bernstein, Peter Eliades, Michael Howell, and others, and of course, myself and Lars. So look forward to anybody who's interested in the Masters Working Group reaching out to Dr. Barton. So have a great holiday, everybody, and I'll see you again in a couple of weeks.